Hi, and welcome back to Property Taxes and You. In today's episode, we're going to be talking about the homestead deduction. We're going to discuss what it is, how it's calculated, and the rules and regulations surrounding it. Now, before we get right into it, I should define what a property tax deduction is. In the simplest sense, a property tax deduction artificially lowers the assessed value of a property. This, in turn, reduces the amount of property taxes due each year. Now, if you caught our first video, you know that to calculate taxes, we take the gross assessed value of a property, subtract any deductions, and then multiply the difference by the tax rate. Now, having said all of that, let's go ahead and dive right in. The homestead deduction is the largest property tax deduction available in the state of Indiana. Coincidentally, it's also the simplest, requirement-wise. The actual law is quite lengthy, but it all boils down to 3 basic rules. And through the magic of video editing, you can see those rules are on the board already. So, rule number 1. Own the property. Ownership in most cases is determined by whose name or names appear on the deed. It can also be determined by whose name or names appear on a recorded contract. Rule number 2. This property must be your primary residence. In the most basic sense, this means that it's your home. It's where you're registered to vote, and it's where you file your income tax return. Rule number 3, closely tied into rule number 2, is that you may only have one homestead. And for the purposes of this deduction, married couples count as a single entity. And that's it. Pretty simple, right? Now, the important thing to remember about this deduction is that the intent behind it is to make it easier for Indiana residents to own their homes. The intent is not to make it easier to own multiple properties. One of the questions we often get regarding this deduction and married couples is this. Say spouse A owns a property and it's deeded in their name only. Spouse B owns another property deeded in their name only. Can they both claim the homestead deduction on these 2 separate properties? The answer is quite simply no. This is why on the application for the homestead deduction, the state now requires that we collect information from both spouses, regardless of whose name does or does not appear on the deed. The information we collect are the last 5 digits of your Social Security and driver's license numbers. Now, it's a sad truth, but for a long time, homestead deduction fraud was pretty rampant across the state. In recent years, however, at least in our county, we've really cracked down on this issue, and I'm happy to report we've made some tremendous progress. Now, all of that said, let's take a look at how this deduction is calculated and what it does for your property taxes. Wow, there's a lot on this board right now, but I promise we're going to make it all make sense. Basically, what we're looking at are 2 scenarios, A and B. In scenario A, we're going to look at a property with a gross assessed value of $200,000. In scenario B, we'll look at a property with a GAV of $1 million. Now, the homestead deduction itself is a 2-part deduction. On your taxes, you'll see it listed as homestead standard and supplemental. Now, for the first part, standard, we're looking at the lesser of 60% GAV or $45,000. For the second part, or supplemental, we'll be looking at 35% of the GAV after the standard has been subtracted that is less than $600,000, and 25% of the GAV after the standard has been subtracted that is more than $600,000. Now, I know that supplemental portion sounds a bit complicated. Promise it's not that bad. Let's go ahead and look at our examples. So, scenario A, GAV of $200,000. For the standard portion of the deduction, we're looking at 60% GAV or $45,000. Well, 60% of $200,000 is $120,000. So, standard portion of the deduction on this property, $45,000. $200,000 minus $45,000 is $155,000. This is less than $600,000. So for the supplemental, we're calculating this at 35%. 35% of 155, $54,250. So for the whole homestead deduction, we're looking at homestead standard, $45,000. Supplemental, $54,250, gives us a total $99,250. If we were to take this and then plug it into our tax calculator, it would look something like this. $200,000 gross assessed value minus deductions, homestead $99,250, gives us a net assessed value of $100,750. And remember, it's this lower NAV that we then apply the tax rate to. With me so far? All right, let's move on to B. GAV of $1 million. Pretty safe to say that first part's going to be 45. So, 1 million minus 45,000 leaves us with 955,000. This is obviously more than 600,000. But for the first 600,000 of this amount, we're calculating at 35%. 35% of 600,000 gives us 210,000. We're still left with 355 though. 355,000 above or more than 600,000. And this amount is calculated at 25%. So 25% of 355, 88,750. The supplemental portion of the deduction is the sum of these two numbers. So when we go to figure out our whole deduction amount, we're looking at 45,000 for the standard plus 210 plus 88,750 for the supplemental. Add that all together and we end up with a homestead deduction of $343,750. Again, throw that into our tax calculator, $1 million GAV minus deductions, $343,750, NAV of $656,250. Still sounds a little complicated, but what does this all mean in dollars and cents? Well, let's say in scenario A, they have no deductions. This is just regular old property. GAV is $200,000. So all we're going to do is we're going to take that $200,000 times the tax rate for this township. Well, let's say the rate is 1.3%. Okay, $200,000 at 1.3% gives us $2,600 a year in property taxes. Let's say the rate's 2%. 2% of 200,000 means you're paying $4,000 a year in property taxes. But this is somebody's home and they've applied for the homestead deduction. So instead of calculating at the actual value of the property, we're calculating at this lower net assessed value. 1.3% of this, $1,309.75. Significantly lower than the $2,600 it would be without the deduction. At 2%, $2,015 for the year. Again, significantly lower than it would be without the deduction. And it's the same down here on the $1 million property. The numbers are just bigger. At 1.3%, you're looking at, without a homestead, taxes for the year, $13,000. With a homestead, taxes for the year, only $8,531.25. 2%, you're looking at the difference between $20,000 without the homestead or $13,125 with the homestead. So, as you can see, the homestead deduction is huge, and it is a giant benefit to homeowners in the state of Indiana. So, how does one apply for this deduction? Well, if this is a new purchase for you, odds are you're going to fill out the application with your sales disclosure at closing, in which case your title or closing company sends us your application, we approve it, stamp it, send a copy back to them, they send that copy to you, bing, bang, boom, done. Now, alternatively, if you've already owned this property for some time and are just now moving in, you can always stop by our office and we will help you fill out an application in person. The whole process takes 5, maybe 10 minutes. Just remember, we'll need Social Security and driver's license numbers for both spouses. Now that's it for this episode, folks. I truly hope that I've explained this deduction in a manner that is understandable. If, however, you or anyone you know has questions about this deduction or any property tax deduction, please feel free to post those questions to the comments section below. Also, you can always email me directly. My email address can be found in the video description. Finally, thank you. Thank you so much for watching. I'm Michael Horsley, and you stay classy, Monroe County.